Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Getting Started with Options. And today, we're going to be talking about a common option strategy that has massive risk associated with it. And then we're going to talk about one step that might be taken to reduce that risk exposure by maybe more than 90%. This is going to be an interesting discussion. We're going to be weighing the pros and cons of naked versus covered option strategies. So a lot to cover. Before we get to any of that, though, let me first of all say hello to everybody who's already chatting in out there in YouTube. As always, great to see those familiar names. Hello there, Will and Mighty Mouse, Eva, Pickle Pug. That's a new one to me. Hello there, Josh and Ricebird and Greg, everybody else. Thanks for joining us week after week. We always appreciate your attendance and your contributions to these discussions. If you are among those who are here for the very first time, welcome. It's great to have you on board. And if you're watching on the YouTube archive after the live stream is concluded, enjoy the recording. That's a great way to watch these webcasts, but you're certainly invited to join us in the live stream if you'd like to be here in our live audience. This is a Tuesday webcast series, and we kick things off promptly at noon Eastern time. Now, I also want to let my live stream audience members know that my very good friend Kevin Horner is hanging out in the chat with us today on YouTube. Kevin's going to be keeping an eye on any questions that come in, and if I can't get to those, Kevin's there to pick them up for me. So thanks for having my back there, Kevin. Kevin and I have been working together for years and years and years, so it's great to have Kevin here. Kevin and I would also like to issue an invitation to everybody listening, whether on the live session or if you're watching on the archive. Follow your favorite Schwab presenters on social media. You can find us on X. You can find us on LinkedIn. You can find and follow Kevin on X at Kevin Horner CS. You can find and follow me on X at Cameron May CS, or you can pop over to linkedin.com/in/Cameron May CS. Give me a follow there. And if you reply to my posts on social media, I just try to reply right back to you. It opens up those channels of communication when the camera's not on. But let's get into this discussion of this one step that may actually reduce a strategy's risk exposure by more than 90%. Interesting topic. Does come at a cost, though, but we're going to weigh both sides. Let's get into this discussion, though, and as we do, of course, since risk is really the topic of the day, as always, we need to bear in mind the risks associated with trading and investing. So keep these disclosures top of mind. Options carry a high level of risk and are not suitable for all investors. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including the loss of principal. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount, and any investment decision you make in your self-directed account is solely your responsibility. All right, so let's get into this discussion of risk management. Maybe a trader recognizes the catastrophic risk potential associated with some strategies, and they might want to take steps, if they're available, to mitigate those risks to the extent possible. So today we're going to be setting up what's known as a naked put option strategy, and then we're going to be mitigating much of that risk with what's known as a bull put spread. So we're going to create that spread with essentially one extra step that may reduce that risk by, could be 90%, doesn't always have to be, could even be more though. So we're going to set up an example trade scenario, create a naked put option, and then turn that into what's called a covered option. And before we're done, we're actually going to be placing an example trade. So let's get into this discussion. Let's go right to the Thinkorswim desktop platform. This is the paper money version of the software. And right now we're looking at Amazon. And by the way, I see that Pickle Pug, you said I better get used to, or I'm going to get used to seeing you here. That's fantastic. I hope that anybody that can join us here in the live stream. It's always great. But of course, a watch on the recordings can be just as valuable. But let's take a look at Amazon. And we're going to look at this through the lens. We're going to be doing a bullish trade today. The trade that benefits if the stock goes up is what we're looking for. And so let's say that we're a trader out there, and they've noted that Amazon has had a price ceiling over the first stretch of about 8 months over the last 12. This is a one-year chart. You'll notice there's a price ceiling right at about that $257 level. Sure, you might look at it $255, $257, whatever, an area of price resistance right around that range. And then as price broke up and through that, that seemed to become a floor for about 6 weeks, broke back down and through, and that same area seems to have become a price ceiling again. And very recently, you'll notice we got well above that ceiling, and we've retreated over the last 2 weeks of trading, bringing us right back down, interestingly, to apparently about that same area. Let's say that our would-be traders' outlook here is for a stock to bounce off that level and go higher. Now, there are a couple of little technical pieces of evidence. I'll cover it quickly. This isn't really a webcast about technical analysis, but it might be interesting to that trader that we got long wicks and long shadows off of these candles right around that same range. So you'll notice right here, big tall wick back in November of last year, big tall wick sticking out the top of that candle body. What that might represent is a particularly dramatic failed effort to get above that 257 level and a strong retreat from that. Now we're getting long shadows as we're above that 257 level, which might mean there's a failed effort to penetrate back down below 257 and then a strong advance back away from that. Now, none of this adds up to a guarantee that where we find ourselves right now is going to lead to price advancing from here, but let's just say that our trader thinks that this is going to happen. The one other piece of technical evidence that I wanted to mention, I said there were a couple. For some, they'll use the proportions of moves to inform the way that they plan their trades. And it's interesting here, right on this earnings announcement, there's a really strong move up and then a retracement against that advance, maybe as profits were taken by those that made a lot of money in a very short period of time here. But interestingly, from this low to this high, we've seen a pullback of almost exactly 50%, which is kind of a common trading assumption. If there's a really strong move in one direction or the other, maybe the profit taking will take us back about 1/3 or 1/2 of that distance. In any case, let's just say that our outlook is for the stock to rise. Now Kevin says it's about a 50% fib level in the last run. Exactly right. If we were to bring out that drawing tool, let's get our fib retracements tool here. And if we were to measure from top to bottom here, using this tool, you can see there's that 50% level right at about that same range. Yep. Let me remove that to uncomplicate the chart here, though. But when a trader has an outlook that's bullish, there are a couple of the most basic, in options trading, nothing is truly simple, but some of the simplest bullish strategies are to buy a call, that's bullish, or to sell a put. And I wanted to talk about that second one today, selling a put. So let's do that. Let's just make an assumption here that our trader thinks we're going to, at the very least, stay above 257 as we advance toward, let's say, this September options expiration cycle, September 18th. So I'm going to go to the trade tab and we're going to go to the options chain here. I'll just go right back up to the top. So here we are looking at Amazon. Here's our options chain. Let's go out here to the September 18th. Those are the 31-day contracts, each of them representing the potential exchange of 100 shares of stock. And I'm going to open that expiration up. And how about we sell the 255 put for our example? Why 255? Because it's just below 257. If I draw a line here, so here's today's candle. Let's go just below that to about 255. Right there, close enough. See that 255 level? If the stock stays above that level, and we hit that September 18th expiration, this trader would be in position, hopefully, to optimize their outcome. So here's exactly what they'd be getting themselves into. If we were to go to that 255 put and sell it, it looks like we might be able to get about $5.70, maybe a little bit more, $5.75, $5.80. But let's say we can maybe squeeze $5.75 out of this. So here's our example strategy. And this is going to be our first one. So I'm going to call this example strategy A. Oops, let's make that bold again. And this is a naked put. Kevin, no, you say you let me finish. I'm not going to be finished talking for 45 minutes, Kevin. So feel free to type. Yeah. But a naked put is we just go to this contract and we sell it. So if we did that, here's what we'd be getting ourselves into. Sell the 18th of September 255 put. And it looks like that's trading right now for about, I said 575. Yeah, it looks like we might still have a good shot at that if we were to place an order right now. 575. Well, let's explore why we might be doing this and what the risks are. That's a big deal associated with doing this. Well, if we're familiar with options contracts, we are literally entering into a contract with another trader somewhere out there in the trading ether, where we are accepting a payment from them of $5.75 per share on 100 shares. That's 575 bucks. It's being paid to us right now, day one, goes into the account. Great. So we have this contribution of cash to the portfolio, but what's the trade-off? Well, we have an obligation if we get into this contract. The obligation in this case is that we're giving someone else the contractual right to sell shares to us. In other words, to put 100 shares of stock stock of Amazon into our account at any time, and in exchange, we'll be required to pay for those shares, $255 per share. That's the deal. At any time, next 31 days, if that other trader decides, Cameron, you know what? I'm going to make you buy these shares according to the terms of this contract. We have to cough up the 255 bucks, and the shares are put into our portfolio. There we go. So that is this naked put. Now, why is it referred to as a naked put? Well, let's run through kind of an uncomfortable scenario here. Let's say we thought the stock was going to rally from where it is at the moment. We thought, all right, it's already pulled back 50%. It's sitting right on this apparently important price floor. It shouldn't go below that. Well, just because we think it shouldn't doesn't mean it can't. So what if the stock were to continue falling? Oh, let me switch up my drawing tool here. Let me remove this drawing. I'm going to switch this to this drawing tool. And let's say, as we're looking out here to the September 18th expiration, that's how long our obligation lasts to this other mystery trader out there. And by the way, it's not a one-to-one relationship with someone. Don't worry about that. But in any case, if the stock continues to fall, how far can it fall if it really has a mind to? What if, let's paint kind of a tragedy scenario here. Let's say it falls all the way back down to these lows. It goes down to 225 bucks. Can it do that in that short of a period? Can it fall that far within 32 days? Absolutely it can. As a matter of fact, it's already done that how many times? 1 time, 2 times, 3 times this is just in the last 12 months. So if we get one of the wrong months, there's a lot of risk exposure here. So if it does that, what does that mean to us? Let's say it's down here at 225 bucks. Well, I accepted a payment of $5.75 and took on myself the obligation to have to buy the shares for $255. Oh no, if they're only worth $225 and I have to pay $255 for those shares, well, and when I say I'm thinking in the mind of this hypothetical trader here, right? Now I'm sitting on an unrealized loss on the shares of $30. Can we say ouch? That's a big deal. Is that relatively catastrophic? Yep, that hurts a lot. And guess what? It doesn't have to stop there. How much is theoretically possible that we could lose on this Amazon trade in the next 32 days? Now, we're definitely venturing into the realm of theory here for a moment. This is not what I actually think is going to happen, but it remains within the realm of possibility. What if Amazon were to just absolutely collapse in value? Not just take a big chunk loss like it has several times this year already, but what if something devastating were to come out? I don't know. I don't know what could lead to this. It could be all kinds of things. But over the next 32 days, let's say the stock falls and falls and falls and falls and falls, and it goes down to $1 per share. You're probably saying to yourself, Cameron, there's no way. It's impossible. It's not impossible. It's highly improbable, but it's not impossible. If the stock were to collapse down to $1 per share, I'm sorry, what does our contract say that we have to pay for it? We have to pay $255 for this nearly valueless stock. Yeah, this can go all the way down to zero. We still have that contract hanging over our heads. We have to buy this stock for way more than it's worth and be staring right in the face of a catastrophic loss. So this is why this is why it is referred to as a naked position. We are quite exposed. If we enter into this contract, we may even have the cash to make the purchase if we need to. $255 per share is a $25,500 obligation minus a $500 credit that we got. So there's $25,000 of risk on this trade in pursuit of $575 of reward. And all of a sudden, for some traders, is it hot in here? Seems a little hot under the collar for me. This is a trade that can come with a ton of risk. Now, if we really look at what's most likely to happen, most likely we're not going to $1, right? Most likely we're not even going down to $2.25. There's a 50-50 shot, just taking all technical analysis, all the convictions about whatever we think might happen with Amazon, that the stock might just go on up from here. Or it might go down, maybe it just doesn't go down very far. But for some traders, this scenario it keeps them up at night. They can't do it. So does that mean we just can't sell puts? Or is there some way that we might reduce that risk exposure, maybe reduce it dramatically? Yes, there's actually one step that might be taken. Greg says, yeah, it's hot in here. We're going to turn this from strategy A, a naked put, into strategy B. Let me take this. And by the way, I'm going to do some specific math. What is the actual risk of this trade? Well, if we have to buy the stock for $255 and we got $5.75 for taking on that risk, let's say that we realize the entire risk. We have to buy an essentially valueless stock for $255 and the $5.75 is our consolation prize. Isn't that $249.25 of risk? Yep, that's what it is. That's the risk of this trade. Well, how do we take one step to dramatically reduce that risk? And I said, let's do at least 90%. Well, here we're going to do what's called a bull put spread. Okay? And it actually starts with exactly the same trade. We sell a put, but the extra step we're going to take is at the same moment we sell that put, we're going to buy a second put. That sounds contradictory. So, Cameron, we're going to take contradictory trades, opposing trades, selling a put and buying a put at the same moment. Isn't that a wash? No, it's not a wash. There's actually profit potential and there's certainly remaining risk potential, but it's going to be a whole lot less. So, at least theoretically, okay? I think you'll feel quite comfortable if I say this is the theoretical risk of this trade, because we may not think it's actually going to fall $255, but it's still theoretically possible. Well, here's our bull put spread. At the same time we sell the 255 put, we're going to look at some other put that doesn't cost as much as the one that we sold. All right? And you'll notice as we go up the option chain to, this is counterintuitive, to lower strikes, 250, 245, 240, the contracts become less costly, lower priced. How about we look at, I'm going to look at this 245 put as an example, okay? But at the same time we sell the one put, we're going to buy a second. And for our initial example, let's look at maybe buying the 245 put. Well, how much is that going to cost us? Looks like somewhere between 268 and 274. Let's say it's $2.70 is the cost of that put. What is this doing for the trade? Why are we spending $2.70 per share? It's $270 that's going back out of the account. Got 575 going in, 270 going out at the same moment. It's going to leave us with a net of about $3.05 or $305. But there is a big thing being accomplished here, and that is dramatic reduction in that theoretical risk of the trade. We know that for this trade, we collected $575, but in exchange, we might have to buy the shares for $255. And as it was originally structured, we didn't know how much we could sell those shares for. Maybe it was going to be $225. Maybe it was going to be $1 or $0. But with this put, we now have the contractual right to sell shares for not less than $245. So we've drawn a line in the sand on our chart, a second line in the sand. Let's make this one precise. Let's edit the properties of this one to make sure this one is $255 on the nose. Now at the same moment, I'm going to zoom in so you can see that a little bit better. See the two? Nope, that didn't help a lot. I'll zoom back out, doesn't matter. Anyway, but we're drawing a line in the sand down here at 245 with this second put. Right there. And I'll be precise with my drawing. Let's edit its properties. Make that right at 245. So here's the deal with this one. Let's go through this initial scenario. And by the way, stock looks like it's rallying a little bit. Are you all congratulating me right now for making such an impressive call on the Amazon stock? No, it can change direction. Anyway, but what if the stock collapses again? It goes down to 225 or down to 1. It actually doesn't matter. Both of those scenarios would produce the same result in this case. Well, if the stock falls down to 225 and someone has the right to sell us shares for 255, they have a strong motivation to do that. They can't get $255 just from the market. So they say, hey, Cameron, guess what? You are obligated to buy my shares for 255. They're only worth 225, so congratulations, here you go. And they enforce the contractual terms, sell those shares to us for 255, and at that moment, do we hit the panic button? Nope. We'd probably say, ouch, I wish this didn't happen. But now we can turn around and sell those same shares to someone else for $245. Yep, that's what our contract says. All right, I might have to buy the shares for $255, but at the same moment, if I need to, I can sell those shares to somebody else for $245. So we've just reduced the risk exposure from $249.25 to how much? Well, it's $10. Except we also got a credit for doing this. It's actually less than $10. Here's the theoretical max loss of this trade. Actually, let me do this. Let's first of all calculate the net credit of this trade. With this one, we just collected $5.75. With this one, we didn't collect quite that much. We collected $5.75, but then we took the extra step and spent $2.70. So that left us with our net credit of $3.05. Not as much as trade A. By the way, this one's still labeled trade A. Let's make it trade B. But we do still have most of the original credit. What's happened to our theoretical loss, though? Well, now, instead of being exposed to $255 of risk, it's $10. Worst case scenario, we have to buy the shares for $255 and we sell those shares for $245. That's a $10 risk, but we already have $305 that was paid to us. So actually, the net in that worst case scenario is now $6.95. And now let's conclude the math here. Let's go up here to our calculator. $6.95 divided by $249.25. That's 3% of the original risk. So we reduced that theoretical maximum loss by 97%. And how much did it cost us? It cost us $2.70. I don't want to be too dismissive of that cost, though, because what it's actually done is it's reduced our credit from $5.75 to $3.05, a $2.70 reduction in a $5.75 credit. We surrendered 47% of our original credit. Yeah, the cost is not inconsequential here. It's 47% less reward potential, but with a 97% risk reduction theoretically. I always have to throw out the theoretical, because we need to talk about a couple of other ways that this trade might go. And one of those means that we might wind up losing more than $6.95. All right. So today we're going to be doing this bull put spread. And let me give this just a moment to treat this. Why is it called a bull put spread? Greg says that $2.70 to help me sleep at night. That's exactly the motivation for lots of spread traders. Yep. But still some things that we need to process before we hit the pillow, right? But first of all, why is this called a bull put spread? Well, both of these strategies, whether we just sell the naked option or we cover it with the long option, there's how we're going from naked to covered. We feel like we've covered ourselves. Both of these are bullish. Both of these work out best, not if the stock collapses, but if the stock goes up. This is just going to make us feel better. Hold on a second. Let me get rid of this drawing. The further we can get away from those contracts on the stock price, the more comfortable we start to feel. If the stock is going up to 270, up to 280, up to 290, and we know that somebody has the right to sell us shares at 255, well, this is becoming less and less. It's becoming vanishingly unlikely they're going to do that. It's still possible. They might decide, hey, Cameron, I'm going to sell you those shares for 255, even though they're worth $290 on the open markets. It's not very likely. It could happen, though. In any case, that wouldn't be a bad thing necessarily. But yeah, the higher this goes, the less likely that we ever have to deal with this. More likely the contracts just expire and we keep that net $3.05 that we were paid, right? Now, we've already discussed what can happen if the stock goes down. So if it goes up, we're feeling better. As long as it doesn't go down below 255, we're in position where these contracts just expire worthless. The other trader has the right to sell us shares for 255, but they probably won't. We have the right to sell those shares for 245, but we're probably not going to if the shares are worth more than that. So we now know if the stock collapses, this might happen, right? If the stock goes up, this might happen. We keep our net credit. This is also our theoretical maximum gain. But we have this sort of nasty term that's still hanging around, theoretical. Why do we keep saying theoretical, Cameron? Well, because there's one other thing that could happen. Let me remove this drawing. Let me remove this drawing. Let's see. Let's remove the trend line. We'll remove this drawing. What if our stock does this kind of unexpectedly? What if it comes down here, goes below 255, but stays above 245? Let's just say we're at 250 at expiration. We let this go all the way to expiration. So come September 18th, close of business, stock's at 250. Well, someone has the right to sell us shares for 255 that are only worth 250. Guess what? They are almost certainly going to exercise that right and assign that contract. So we're going to be sold the shares for 255. They're only worth 250. And at that moment, we might think, that's okay, I got my escape hatch in place. I have the right to sell those same shares to someone else for 245, except pump the brakes. That's not a good idea. If the shares are worth 250, why in the world would I sell at 245 even if we have the right to do that? In that case, we don't. We don't sell those shares, and instead, we've just wound up buying the shares for 255 bucks. So in that case, we'd be underwater on the shares by $5, but still shareholders. And the $3.05 has compensated us a little bit for being underwater on the shares, but overall, we're still a little bit below break even. But just be aware, at expiration, if we're assigned the shares and we don't sell those shares, well, now we're just shareholders, and that changes the risk profile entirely. Because what might happen, we got to sign the shares, and then let's say there's some great news that comes out over the weekend, and the shares gap up huge in value. Well, awesome, because we own the shares at 255. Now we're back on the profit side of things. Or we get assigned the shares, and over the weekend, really bad news comes out, and those shares drop in value before we can do anything with them on Monday, unless we're trading after hours anyway, or pre-market. Yeah, there's huge risk associated with owning shares, but it's the same risk that we would be very familiar with just as being shareholders under any circumstances. Just be aware that that does change this risk profile. So that's why I say theoretical maximum gain and theoretical maximum loss. If we wind up as shareholders, that changes it. One other thing that could change things is if we decide to exit under whatever scenario before expiration. But guys, that is that one additional step that somebody might take to turn a naked position into a covered position, to change catastrophic risk exposure to substantially reduced theoretical risk exposure. That one extra step is buying that put. So how about we go place this trade? Let's go to our trade tab. And by the way, let me place the trade, and then we'll talk about a couple of variations on this, because this isn't the only way. Just because I used the 245 as the example doesn't mean that's the only choice we had. But in any case, let's place this trade. And a quick way to place this trade is to remember to hold down the control key on your keyboard. Here's what I'm talking about. If we come to that 255 put, that's the one that we want to sell. We can click on the bid price to create that sell order. There's that naked put. In my portfolio, in my account, it's going to prepare an order to sell one contract. By default, it's probably going to prepare an order to sell 10 contracts, so be aware of that. We might need to customize that quantity to wherever comfortable for the trader. But here's how we complete that vertical spread. Let's go back up here to the 245, and I'm going to hold down the control key on my keyboard and click on the ask price. And as I'm holding down the control key, the signal that's sending to Thinkorswim is, oh, okay, Cameron wants to keep the original order and add another one to it. So as I click on the ask price for the one that I want to buy, that adds the buy order to the sell order, and it creates this vertical spread. And right now, it looks like 305 isn't really in the cards at the moment. Might be closer to, let's say, 280, because prices have changed. Since we started this discussion, the stock price has gone up. And that's caused puts to be less valuable, so we can get a smaller credit for this trade that we were discussing even just 20 or 30 minutes ago. Anyway, let's go ahead and place this order. I'm going to try to get it filled for $2.80 per share. So on a $10 wide spread, that might leave, instead of $6.95, it might leave more like $7.20 as our risk. But let's click confirm and send. We're going to sell this one vertical, this 18th of September, 255, 245 put spread, trying to get a 280 credit. That would leave us with a maximum theoretical profit of $280, a maximum loss of $720. Remember, what was the loss before? The potential of the naked position, $25,000. Yep. There is a commission to be paid on this trade, on the contract that we're selling and the contract that we're buying. Adds up to $1.30. That can increase the cost of this trade by that $1.30. Or pardon me, not the cost of trade, reduce the net credit of this trade by $1.30. But let's send this order off. And while that's waiting, let's talk about different ways that we might have constructed this. Because I did kind of just sort of grab the put that we're going to buy kind of at random. We're selling the 255. We knew that we wanted to buy one that was less expensive, so we're not spending the full credit of what we're receiving. But what if I wanted more protection, even greater theoretical risk reduction? Well, in that case, it's going to cost me more for it. If I want to reduce my risk by a greater amount, I think it makes sense. It costs more to reduce that risk. So we're going to have to buy a more expensive contract than the one that we've selected. So for example, maybe we sell the 255 and buy the 250, which would mean, yes, we are obligated to potentially buy the shares at 255, but worst case scenario, we could sell those for 250. That's barely $5 of risk potential, but the protection costs more. Instead of spending $2.70 or whatever it's trading for right now, a little bit less, $2.65, that might cost us $3.80 or $3.90. It's taking a much bigger chunk out of the credit that we received. Now, what if we were okay with taking a larger risk? Cameron, you said we were going to reduce risk by 90%. We actually reduced risk by 97%. Well, if we're willing to keep that risk dialed up a bit more, we can spend less for protection. For example, what if we bought the 235 put? That one only costs probably around $1.25, something like that. So we'd be able to keep more of that original credit. Maybe $4 of that original credit versus just $3. Well, we keep more of the credit, but the protection isn't as good. If we get stuck with the shares at 255 and those shares are collapsing in value, well, now we might have to sell them for 235. That's $20 of loss on the stock instead of $10. So very customizable strategy, this strategy. Just depends on how much risk the trader prefers. And to reduce the risk, we pay more. To take a larger risk, we pay less. There we go. Kbo just says, what's the closing price? I'm not sure quite what you're referring to there, Kboja, but a discussion that we'll have in another webcast. I've had deep discussions about exiting these kinds of strategies. Today, I just wanted to focus on the strategy itself. So if it's our first exposure to a bull put spread, to taking this extra step to reduce that theoretical maximum loss or that risk, hopefully this is a good introduction to you. But guys, we've accomplished what I set out to do today. I wanted to talk through the massive risk exposure associated with naked options and the one additional step that might be taken by a trader to reduce that risk exposure and potentially very dramatically. In many, many cases, maybe the majority of cases, more than 90%. But there's a trade-off. We've already seen that. It costs us a chunk of the credit. It reduces the profit potential of the trade substantially as well. So, okay, so Kbo just says, what was the exiting price? Yeah, we'll talk about that in a future webcast. But a common exit is if the stock is collapsing. Let's say that our theory for taking the trade was that we're going to stay above this support. If the support breaks, maybe the trader looks at what it might cost to buy out of this trade. And it's probably going to be more than the 305 credit or the 280 in the case of the order that we actually placed, but probably less than the original maximum loss calculated. All right, but guys, time for me to let you go. Thanks for giving me your time today. This is what we do on Tuesdays. We talk about option strategies, and I try to go from that beginner perspective, go at a pace that hopefully everybody can follow. I do have a suggestion for you, though. If you are brand new to options trading, I did make some assumptions about the level of experience here. If you're brand new, I've actually put together a series of video lessons for you that just start right at the very basics, the building blocks of trading options. So let me show you where to find those. And as I do that, big heads up, if you are brand new to the channel, welcome. It's great to have you here. I would definitely strongly suggest that you subscribe to our Trader Talks channel on YouTube, the Trader Talks Schwab Coaching webcast page on YouTube is where we house these live streams. It's where you can join these live streams like the one that I'm hosting right now, but you can also find playlists of previous webcasts, including this webcast series, the Getting Started with Options webcast series, and the series of lessons that I've put together. So if we go to playlists and we start to scroll down just a little bit, look for, do you see my face just off here to the left? I'm going to point almost at it, just above here, right up here. It says start here to learn about trading options. If you click on view full playlists, you'll see that this is a series of lessons. Lesson 1 of 10, trading options, building block number 1, long calls. We talk about what long calls are, how they're traded. Then we get into long puts. Then we talk about selling calls and selling puts. Then we start to combine them into different strategies. So there's a great starting point. But our YouTube channel is a fabulous resource full of lots of different webcasts on a range of topics. So make sure you're subscribed, but also make sure that you're following your favorite Schwab presenters on social media. So you can find Kevin and me and our peers on X. You can find us on LinkedIn. So to find Kevin on X, you just go to @KevinHornerCS. So find me on X, you go to @CameronMayCS. That's my handle on X. And if you give me a follow here, you'll notice that I post frequently. And if you reply to my posts, I just try to reply right back to you. This is the place to connect with your Schwab presenters in between the videos or in between the live streams. Now, you can also pop over to LinkedIn. Go to linkedin.com/in. And then my handle again is Cameron May CS on this platform as well. And if you give me a follow here, you leave a comment on one of my posts, I just try to reply right back to you again. Shannon, you like that? Very good. Living Natural says you're new to trading. Excellent. Bill Harrison says this strategy that we've discussed today is also called a credit spread. Exactly right. Yep. Falls in, there are actually multiple types of credit spreads, but combinations of option strategies that result in a net credit, commonly referred to as a credit spread. Everybody, thanks for giving me your time today. Thanks for all the thumbs up out there on YouTube. I saw over 100 people watching a live stream. And as I refresh the browser there, I can see, 51 have already clicked the thumbs up. Thank you for doing that. Anytime you watch a webcast, if you enjoyed it, make sure you always click that like button. Whether you're watching the live one or you're watching the recording, it all helps. It's all, of course, a pat on the back to your presenter for a job well done, but it also gives my videos a boost in the YouTube algorithm and helps more people find these videos. So it's always helpful, always appreciated. Hey, Kevin, thanks for helping out in chat. I'm going to scroll back up through the chat one more time. Yep, looks like we're good there. I will see you in a future webcast, everyone. I'll also look for you on X and on LinkedIn. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.